Welcome to Shadow of Truth with your host, Dave Kranzler from InvestmentResearchDynamics.com and Rory Hall from thedailycoin.org. And today is August the 1st, 2016. It's a Monday. And also, Dave, what is today?
It's our 100th show anniversary, as far as I can tell.
100 shows. Woohoo! It's not an anniversary because we started, I think, in March. We have done 100 shows now, which is pretty cool.
Very cool. And it certainly has been fun.
It has been fun. I really appreciate all the knowledge and all the wisdom that you have shared. And hopefully I've added some color commentary to the whole thing.
Well, likewise yourself on the knowledge and wisdom. Don't discount that.
Oh, I don't discount any of it. It's just how I am.
I hear you.
Oh, well, we've got a lot of ground to cover, so we should probably move away from the love fest and get on with it.
Let's rumble. You would think the market would be falling off a cliff, and then when you look at the market, it starts off red and then it goes green again. And some of the most overvalued stocks out there are the ones that are up the most today. I mean, it's unbelievable.
Well,
I seriously think that a suitcase nuclear bomb could go off in Times Square, and the Dow Jones and the S&P would shoot up 5% on that news.
That wouldn't surprise me in the least. I mean, it's as we discussed, I believe it was Thursday, the MOPE, the Management of Perception Economics. I mean, they have to use those tools to make the masses believe that everything is just hunky-dunky. It's all great. I know GDP fell off a cliff and the numbers for the first quarter were awful. Numbers for the second quarter are terrible and probably going to be revised down. It doesn't matter. Your 401k went up. Your IRA went up. Yay! Life is good.
Actually, that's what's interesting about that, because pension funds have had a very poor year. The reason is that they're invested in all kinds of different sectors. So this would be your 401k, and a lot of these pension funds farm out a ton of money to hedge funds. Hedge funds, I think, might be in general negative, on average negative on the year.
Wouldn't surprise me in the least.
Right. And they farm out a lot of money to the private equity funds. And technically the private equity funds, if they had to market, they would be down also. No one knows how they mark their stuff. So, I mean, the equivalent to that would be, imagine in the internet bubble era where you didn't know you couldn't observe what the prices of the stocks of these companies were doing, and therefore you just marked them where you wanted them to. That's what these private equity funds are doing. And then a lot of pensions and a lot of 401ks are at least 50% in fixed income, and fixed income has no return on it right now. So
when you say fixed income, that's really bonds, isn't it, or annuities?
Yeah,
I mean,
bonds and mortgage paper and things like that. If anything, I think mortgages may be down a little bit this year because they've widened versus treasuries a little bit. So,
well, I mean, I don't know if you had a chance to read that article that I wrote back on July the 22nd called "Pensions Underfunded, Underperforming, and Unable to Pay."
I did see that.
I cited what you and I have discussed and what we're discussing right now, and pointed out the fact that the CalPERS, the California Public Employees Retirement System, I mean, they're dead broke. They're dead. They are $100 million. I'm sorry, $100 billion short of meeting its future obligations. They have missed their targets, not for 3 years or 5 years, but for the last 20 years. They have missed their projected target of performance. They are not going to be able to pay, period, ever. How do you recover $100 billion in shortfalls.
Well, see, it's actually even worse than that, because all these pension funds they have a lot of their sectors are not marked to market. So, for instance, their private equity investment, the sector. I know a lot of these pensions kind of maxed out the amount that they can throw into private equity because, first of all, they don't have to market a true mark to market, and second of all, for a while it was one of the areas of the market that was performing well. So a lot of these pension funds are between 10 and 20% allocated into just private equity. That doesn't even include their hedge fund allocations. So you get, and this is part of the reason why the Fed is propping up the stock market, because if the stock market goes down more than 10% for any extended period of time, all these pension funds will go broke. My buddy who works at a pension fund did a comprehensive study on it, and he was just horrified when he figured out what was really going on with these things. So, the thing of it is, you start getting a sell-off in the stock market, and all of a sudden, CalPERS' $100 billion underfunding turns into a $200 billion underfunding, and they're going to have to cut benefits.
Or eliminate them altogether for certain segments, certain ages or whatever.
Yeah, the whole thing's going to have to change. And the same thing with Social Security. Social Security's out of money now.
Well, it's been out of money. That's
right, but it is out.
As opposed to just being out, it's completely out.
Right, and apparently the outflows started exceeding the inflows into the fund in 2010. So, it's essentially out of money.
Good Lord. Gold and silver seem to be holding their own. They're trying to. It looks like they're trying to beat things down, but they're not doing a very good job of it this morning. It looks like they're still pretty stable and holding in the range that they need to be holding in. Eric Dubin and I swapped a couple of emails over the weekend, and he was saying, he sent me one this morning saying that, talking about the 2050 mark for silver, and that if it can hold above 2050, that we should see $21, $22 possibly by the end of the week.
Maybe. Yeah, a lot of it is based on technicals, things like that. And in some respects, the technicals and the charts become self-fulfilling prophecy.
Yeah.
But again, I think we're getting into a situation where, even though you can't really see it and it's hard to measure, I do think that there's a physical deficit in deliverable gold. And I think, especially since the Brexit, I think a lot more large, sophisticated entities and very wealthy people, especially over in Europe, are demanding that they have their gold physically delivered. And there was an interesting development on the COMEX. The first delivery date was Friday. And notices go out the night before the actual calendar first delivery day. That's how it works. And on last Friday, this is my buddy, quote unquote, Jesse of Jesse's Cafe Americain, put together these numbers, and he's got them posted on his website, but he sent them to me and Bill Murphy Friday. There was a total of 5,000 contracts that were delivered on Friday. So that's 500,000 ounces of gold. And what was interesting about it was the entities that issued or that were delivering the gold were Goldman and Nova Scotia. And Goldman issued 947 deliveries, and to me, I find it a little bit too coincidental that HSBC, and that was from Goldman's customer account, and we know Goldman's been out there beating the trees, a bearish story on gold. So my theory is, they were looking to get their customers to cough up gold. HSBC took delivery of 988 contracts into its house account. As it turns out, HSBC is custodian of GLD. And then the really interesting one is Bank Nova Scotia issued 4,067 deliveries. And Bank Nova Scotia is part of the London Fix, and it's also Scotia Capital, a subsidiary, is an authorized participant of the GLD trust, which means that they can take shares and turn them into the trust and remove gold. And I just think, you're looking at 400,000 ounces of gold. That's a lot of deliveries to make in one day. And if you kind of match up where they went, a little over 1,000 went to Macary's house account, and pretty much the rest of it, other than little bits and pieces, went to JPMorgan, both its house and its customer account. So I just thought it was an interesting swapping of gold between the major bullion banks on Friday on the COMEX. And then I looked at it today, essentially another 1,800 contracts were being delivered today, actually. So they were, it was issued Friday night. So that's when it would have been issued. So you're looking at, so far, just in the first 2 delivery days. Now, August is the largest delivery month for gold of the year. But in the first 2 delivery days, you've had over 680,000 ounces of gold that have been delivered on the COMEX. And to me, and again, I stopped following it closely a few years ago. So I think in the context of everything, I think that's even in the context of August being the largest delivery month, that's a huge amount of gold to be delivered in the first couple days.
It's a lot of gold.
Right.
That is a lot of gold. And when you were talking about Scotia and JPMorgan swapping gold back and forth, whatever they were doing up there, the only thing I could think of was that JPMorgan has been recently named as one of the sub-custodians of the GLD. And as a sub-custodian, they're not subject to audits or anything. They don't have to. It's completely opaque. So they can do with that. I mean, it could just be a ledger entry, that and no gold exists. I'm not saying that that's the case. I'm just saying that that's in the realm of possibilities. But if you're delivering 600,000 ounces of gold in 2 days, that's a lot of gold.
Absolutely. And here's it's hard to match up deliveries with the actual movement that they report in and out of the COMEX warehouse, so the gold warehouse. But if you just look at 680,000 ounces of gold, it's 32% of what the COMEX is reporting to be in the registered account, which is the gold that's been made available for delivery by people who keep their gold on the COMEX. So you've already had a third of that claimed. Now, I can guarantee you over the course of the next 4 or 5 days, you're probably not going to see a huge change in that registered account, because they don't, who knows what's real and what's not with the COMEX anymore, especially when it comes to reporting their, the gold inventories in the vaults there.
Well, they don't have to report anything. It could all just be smoke and mirrors and lines on a ledger sheet. They as I'm sure you remember a few years ago, they sent out a note to all their customers saying, or a memo saying, take the information for what you will. It may or may not be accurate, and there it is. So,
and what's to me, again, just to kind of circle back to this, what's interesting. First of all, I made a mistake. I said Bank Nova Scotia is a part of the London Gold Fix, and they may well be. I didn't confirm that on Friday, but they are a sub-custodian of GLD. And okay. Scotia Capital is an authorized participant. So, it's kind of, moving gold from one pocket to the other. Bank Scotia is an unaudited vault custodian for GLD, and Scotia Capital can pretty much freely remove gold from GLD at their whim.
So they kind of operate kind of like QE with the Federal Reserve. They just take, instead of taking digital dollars and moving them from the left pocket to the right pocket, they take digital gold and move it from the left vault to the right vault, and say, see, there it is.
Exactly. And they're only showing it on paper. Of course, there's a lot of people out there who actually believe those numbers, but anything that's shown to the public is strictly on paper. It hasn't been verified. But just to kind of, I guess maybe just to sew up this segment, we've been talking about how there's something going on in the physical market versus the paper, and that's what's pushing the price of gold higher. And again, I think we're seeing it today. They tried to smash gold when the COMEX opened, and it bounced right back. Silver, at least the last time I looked about 10 minutes ago, yep, silver's up 20 cents on the day. Gold's barely red now. It's probably going to go green. And I just think we're starting to see, even though it's kind of like an invisible hand, I think we're seeing something significant that's going on in the physical market. And I think that this first 2 days of delivery data from the COMEX kind of are testament to that.
Sounds like it to me.
But I did kind of want to mention something that is, well, as you like to say, grinding my gears. And it came about when I was putting together the idea for my short sellers journal this week, and the company I was profiling reported their earnings last week. And we've talked about, how these companies now pretty much report non-GAAP and really don't pay much attention to GAAP.
Right.
And non-GAAP would be, they they call it their adjusted net income or their adjusted EBITDA, and it would contain add backs that would not be allowed if these companies could only just present their GAAP numbers, which is the way it was until the internet bubble era, and that's what really ushered in this as adjusted or non-GAAP. It was really, and that's really when the fraud in this country started to really take off. And I just want to point out, I don't think it's coincidental that the fraud in this country, political and economic and financial, really started taking off when Bill Clinton was in office.
Well, I wanted to comment on the GAAP, the generally accepted accounting principles or practices, versus non-GAAP. Non-GAAP is code for fraud, in my opinion.
It is.
I mean, that's all that it is, or extortion, or whatever, however they want to use it. I mean, it doesn't matter. I mean, it is illegal and should not be accepted as any type of accounting practice, but it is. Now they just, once again, and this shows the depths of the corruption that we're dealing with when fraud has a new name, and we'll call it non-GAAP, and that is accepted across the board. And people go, well, yeah, it's just non-GAAP accounting practices. No, it's fraud. It's called fraud. I mean, and that's what kills me. It's like, got to be kidding me.
Well, and that's correct. And I just wanted to just put out an example, and this is one of the more blatant examples. So what happens is a lot of these companies, especially the tech-oriented companies, will pay their employees with stock compensation, and that'll be part of their salary. So if your salary is $100,000 a year, you might get, say, $20,000, $30,000 in stock, and then you can, after 4 months, you can register it and dump it. And actually, you get some companies like Amazon. I mean, they're paying up to 50% of their compensation in stock. Now, the effect that has is that the stock being paid out as compensation isn't a cash salary expense, but they do have to report the value of the stock that's awarded in their GAAP income statements. So the effect is that the salary expense is the cash salary plus the value of the stock that's paid out. Okay, so that's your GAAP number. what happens is they say, okay, well, our non-GAAP earnings is, and what they do is they take the value of the stock salary compensation and they add that back into their operating income. So it has the effect of increasing the perceived operating income. And then it, of course, filters down and increases the net income per share. Now, the theory there is that it's, well, stock compensation is a non-cash compensation and it doesn't affect, the amount of cash that quarter that's available to the shareholders. But that's not true, because guess what? It's actually a very quiet and hidden dilution of shareholders, because what happens is it does show up 3 or 4 quarters down the road. And actually it shows up on a rolling basis now, because these companies have been doing it for so long that every month employees are filing stock and dumping it on the market. So what happens is that quietly the number of shares outstanding every quarter increases. But that doesn't show up in what gets reported as earnings. However, the net effect of that is that the stock that was awarded, say, 2 quarters ago, all of a sudden shows up in the form of more shares, and it in effect decreases the amount of net income available to the shareholders in the current quarter. Do you see what I'm saying?
Yep.
So it's not a direct cost to shareholders in the quarter when the company is reporting non-GAAP, but it shows up in the next quarter and the next quarter after that in the form of share dilution. Well, and that's why it's fraudulent to report non-GAAP. And if they're going to do that, they should at least be a disclosure right after they say this is our non-GAAP earnings. Okay, here's what makes it non-GAAP, and here's going to be the effect on you as a shareholder next quarter or 2 quarters from now. Because in effect, it does actually cost. It's a cost that's bared by the shareholders. And therefore, to me, they shouldn't even let these companies report non-GAAP. If you're going to have an accrual accounting system, which is what the GAAP-based system is, then report the GAAP numbers, and that's it. And that's what the numbers are.
Well, but then they would be shown as a Ponzi scheme. So, and that's not going to happen. And the thing is that the shareholders don't really care. Or do they? I mean, do the shareholders care? I mean,
the shareholders would care if they know what's going on, but most of them don't understand what's going on, and that's the problem. I don't even think the institutional shareholders, the pension funds and the mutual funds, I don't think those analysts understand what's going on. And if they do understand what's going on, they don't care, because they'd rather have these companies fluff up their earnings with non-GAAP fraud, because it helps the stock stay aloft.
That's correct. I mean, and that's why I say they don't care. I mean, it doesn't matter that Amazon is a Ponzi scheme. It doesn't. They don't care. The institutional investor, the retail investor, they don't care. Did my 401k go up? Did my hedge fund go up? Hey, it's all good. It's all good, Dave. It's all good. You don't get it. You don't understand accounting. You don't understand accounting in the 21st century when nothing but Ponzi schemes are the norm. So you need to get with the program and quit your fussing about all of these GAAP, non-GAAP issues and throwing words around like fraud. You need to go out and buy you a bunch of FANGs, the Facebook, Amazon, and Netflix, and the Google. You need to go out and get loaded up on those, because that's how it works. I mean, right? I mean, that's the narrative.
Absolutely.
That is the narrative that is sold over and over and over, and everybody goes, yeah, cool. And it's not. I mean, the thing is that I'm curious. I still come back to China and Russia in particular, and possibly India, with outside looking in and going, what are they doing over there? They have a treasonous criminal who should be in prison running for president. They have a maniac who is a billionaire running around. He's running for president. They have fraud, and they call it a stock market. They have a Ponzi scheme. We'll call that the Treasury Department. What's happening in this country? mean, it's from outside looking in, it's got to just look like some kind of clown show.
It does, and I think that those countries are doing their best to try and avoid doing anything that causes the U.S. to start pushing buttons and attacking these countries. And it's really what's going on in the South Seas, and it's what's going on in around Russia's borders, specifically Ukraine and Poland, etc.
Yep.
And I think what these guys are trying to do is just do whatever they can so that they avoid confrontation. It sounds like things are starting to really heat up in the South Seas, though.
Yeah, the South China Sea is becoming more of an issue, and China's had it. I mean, their diplomacy and their strength of will keep them from pushing a button first. But the neocons and the crazies that are in the Pentagon and in the White House, I don't think that they have that strength of will. I don't think they have that resolve to. I think they want a war. I think they need a war. That's what they need, a war, because of the problems that we have.
Yes.
And something that I discovered over the weekend that I've spent a lot of time studying and researching this past weekend is what's going on at the IMF with the SDR. I've written a couple of papers on it, and J.C. Collins over at Philosophy of Metrics, he's done a brilliant job. Larry White, I can't remember his website, but he's done a brilliant job as well, keeping up with the SDR in particular and what's happening at the IMF. And if you go back, what I'm seeing, Dave, is that China is making a big stink at the international level within the monetary system, and it looks like some of these issues with the South China Sea are probably tied to that, even though it hasn't come out. That's the conclusion that I've reached anyway. Could be dead wrong, but it looks like, because all of they just released a memo on July the 15th where China explicitly said that they want to begin issuing SDR bonds through China. And if that happens, then that means big trouble for the U.S. Treasury, for the U.S. bonds.
Interesting.
Yeah. I mean, it could get ugly and get nasty very, very quickly.
On that happy note, should we wrap up our 100th show of The Shadow of Truth?
100 shows for The Shadow of Truth. Thank you, Dave, for reminding me of that. This is it, folks. I don't know how Dave put up with me for 100 shows, or maybe it's me that's put up with him.
It's definitely you've put up with me. The thing that I can't believe is that I don't start pronouncing the month July. Because now whenever I think of the month July, all I can think of is July.
Oh, my goodness. Oh, Lord, have mercy. This is what I had to put up with, folks.
Not that there's anything wrong with that, especially in Tennessee, but that's not how we say it in Colorado.
Well, that's not how I say it. Oh, my goodness. Well, there we go. Now we've left them with a lot of laughter, and I guess we'll pick it up on Thursday, Dave, and see where we stand.
That sounds good to me.
All right, buddy.